Super good day, my dear friends and everyone watching this video. This video aims to educate who are willing to learn something basic in accounting. To start, let's thank God first by reading good news. We have here Proverbs chapter 3 verse 5 to 6. Trust in the Lord with all your heart and lean not on your own understanding. In all your ways submit to Him, and He will make your path straight. So we are gonna discuss basic accounting for non-accountants. What do you expect from this video? This video aims to discuss basic accounting, correlate theories learned with samples, and provide a practical approach. So for our discussion, we have the key concepts, samples for easy understanding. For the financial statements, what are the financial statements? Financial statements are reports that provide information about the company's financial status, performance, and changes in the financial position which are useful to management in making their business decisions. So what are the types of financial statements? We have the balance sheet, or what you call statement of financial position. We have income statement or profit and loss statement. And we have the statements of cash flow. For our discussion, we have three parts. Part 1 is the balance sheet or statement of financial position, which we will be discussing today. And the rest of the topic will be discussed in the future videos. So we have here the balance sheet or the financial statement position. Balance sheet. Balance sheet presents a summary of a company's financial position at a given point in time. Assets indicate what the company owns, while liabilities and equity indicate how it financed what it owns. So under liabilities indicate what the company has borrowed, while in equity represents the owner's investment or its initial capital. So for the balance sheet, we have the assets or the owned by the company, which has commercial or economic value used to produce resources necessary in the conduct of business. Equals liabilities. These are owned from external parties on the assets of the company. These are claims of creditors, debts, or obligations. Plus owner's equity. These are claims of owners or stockholders on the asset of the company. These are capital invested and accumulated earnings. Why is it called a balance sheet? It is called a balance sheet because the two halves must balance. This means the total value of company's asset will all have been funded through liabilities or equity. We have here sample of balance sheet wherein indicates the contains information as of a certain date and the total asset balance out total liabilities and equity. And this one refers to accumulated earnings not yet returned to shareholder. So that will be the part 1 of 1. And for the succeeding slides, we will be tackling bookkeeping as compared to balance sheet. So in here, we have sample number 1. Mr. Cruz opened a store that sells hardware. he invested 1 million as initial capital. So in this case, what will be the journal entry and how will this be shown in the balance sheet? So for the journal entry, we have debit cash and credit capital. So this is to record the initial investment of Mr. Cruz. So in the balance sheet, it will be shown as under asset, it is cash of 1 million, and under owner's equity, it is positioned as capital of 1 million. Sample number 2. Mr. Cruz purchased steel bars, 500 steel bars, that he intends to sell in his store. He paid his supplier in cash at cost of 200 per piece. So, what will be the journal entry and how will be this shown in the balance sheet? So, for the journal entry, we have inventory of 100,000 and cash of 100,000 presented at credit side. So, this is to record purchase of steel bars. 100,000 came from 200 pesos times 500 steel bars. So for the balance sheet, it is presented as deduction in cash and addition in inventory. So for our next sample, we have Mr. Cruz sold 300 steel bars at selling price of 250 per piece. His customer paid in cash. What will be the journal entry and how will this be shown in the balance sheet? So the journal entry, debit cash of 75,000, credit inventory of 60,000, and credit earnings of 15,000. This is to record the sale of steel bars. So for the balance sheet, we have cash addition of 75,000. It came from 250, which is the selling price, times 300 steel bars. While deduction of 60,000 in inventory, this came from 200 because 200 is the cost of steel bar per piece times 300. So the sum of 60,000. And the 15,000, which is the earnings, it is stated in the owner's equity. That ends the part 1 of our discussion. So the part 2 will be the income statement. This will be shown on the next video coming very, very soon. Thank you so much, guys. Thank you, Lord, and God bless us all. Please subscribe, like, and share. Click the notification bell for more updates. This is from your VLL Love.